Hi everybody, Aaron Nindis here, your loan pro from Denver, Colorado with another episode of How Much Mortgage Can I Afford? Today I'm actually going to have a little bit of a drift backwards in time. I've talked a lot about conventional loans against FHA, and now I want to talk about why FHA becomes a more dominant program we might be seeing in today's market. So stay tuned for that info. As always, if you like the information, make sure you like, subscribe, follow, do what you need to keep getting the episodes delivered to you every week. Otherwise, thanks for joining me on another episode of How Much Mortgage Can I Afford? Well, thanks again for joining me for this episode. You know, in the past, I've talked about how competitive, sometimes more competitive, a conventional loan can be than FHA. But I've also done a couple recent episodes about interest rates rising and how that could potentially impact you on your purchase, why it's happening. Well, now the time has come where the rubber is hitting the pavement. We are seeing effectively interest rates are increased. It's somewhere in the range of about 3/8 to 0.5% higher than probably what you would have been quoted at the end of last year. When that happens, a couple things start to happen from a qualification standpoint. Now, if you started your home search going back into December and you were pre-qualified or pre-approved, let's say on a $300,000 home, well, the price of the home isn't what you're really pre-qualified for. It's actually the amount of debt. What I mean by that is the monthly payment for principal, interest, taxes, insurance, if there's applicable HOA, mortgage insurance. That all needs to be under a certain amount. And let's say that amount was $1,800, and that is how you arrived at a $300,000 home. Okay. Here's the problem. Interest rates have increased, and as they go up, payments go up because you're paying now more interest, which is going to start to narrow down your purchase price. If $300,000 were your top end, it may be $280,000 now. It might be $285,000. I mean, there's a point in there where it would narrow down. The reason I bring this up is because there are a lot of clients that went out and they have been shopping for homes, and they know that they're approved on a conventional loan up to, let's just say, $2,000. And they find a home that meets their last conversation about what they expected. Well, the reality is because rates have gone up, payments going up. And so that house might now be too expensive. So what we're seeing a lot of is folks who start off on a conventional loan but now are making FHA offers. It is very important that we have that conversation, we being the buyer and their lender, prior to writing the offer, because when you write an offer, the offer specifically states what kind of financing you're going to be using. Now, in this tumultuous time, it's not unheard of for an agent to mark FHA and conventional on the contract, alluding to it could be both. And that may be a great provision for someone who is still looking to buy at a certain price point, knowing that they might cross the threshold. Now, what is that threshold? What we're talking about is debt-to-income ratio. The debt-to-income ratio on an FHA loan is higher, meaning they allow you to purchase more for your income than a conventional loan. That's pretty much across the board. But one big change coming March 1st is most mortgage insurance companies are taking people whose credit score is below 700 for a conventional loan and capping them at 45%. We used to be able to go up to 50% of someone's gross income if the automated approval would say, yep, give this person a loan. By being capped at 45, regardless of the AUS findings, that is going to further limit how many people are able to use a conventional loan if your credit score is below 700. So what's this mean for you? Well, this means that you might want to consider or open your mind to the possibility that even though getting pre-qualified and pre-approved on a specific program makes all the sense of the world, you might have to switch midstream. And by midstream, I mean once you go under contract. If you go under contract, the taxes were higher, the interest rate's higher, whatever the case is, and the payment's over that conventional threshold, your best bet is to flip back to FHA, where they have that higher debt-to-income ratio. Now, I'm going to give one pro tip for everyone out there that if you feel like this could be you, that you might go from a conventional loan to an FHA loan, keep in mind your student loans. If you have student loan payments, the reason is FHA requires a lender to use 1% of the outstanding balance or the fully amortized payment, which is around 1%, to qualify you. The issue is that there's many folks who are on economic payments. And when you're on economic payments, you're actually making a lower payment than a fully amortized payment. That is why they call it economic. Okay? Well, a conventional loan allows me to use that payment, specifically Fannie Mae, but FHA wants that 1%. So if you are at 50% on an economic payment and you have a large amount, let's say over $50,000 worth of student loans, if you're on economic payments, you could actually see the payment that we must qualify you with on an FHA still put you over that maximum, which is 57 on the debt-to-income ratio. Bottom line is flexibility is the name of the game right now. And that goes so far into everything. Flexibility on how you write your contracts, flexibility in what type of home you want, and flexibility ultimately in the program you end up with. So food for thought for this week. Next week, I'm going to be doing a great series about FHA loans anyway, since we're seeing them become a little bit more prevalent in this rising rate environment. So make sure you subscribe for that. Otherwise, appreciate you watching this episode of How Much Mortgage Can I Afford?